He just moved to Miami, young guy, just married. He had some restaurants with his family back home, but had zero real estate experience. I mean, zero. He didn't know what a cap rate was. He'd never spoken to a commercial broker before, never underwritten a deal or even walked a multifamily property in his entire life. His name? Ricardo. About 2 years after we started working together, I got on a plane to North Carolina to walk a property with him. See, an LOI he had submitted got accepted. So we went to Winston-Salem. And I decided to be there, or I needed to be there, for what came next. See, in this video, I'm going to show you exactly how we got from that first conversation in Miami to that parking lot in North Carolina. And I'm going to walk you through the 3 things I taught Ricardo that I teach every single student who comes to me wanting to get into the multifamily world for the first time. Hey, my name is Nizan Mosery. I've been in the multifamily real estate game for over 15 years. My team and I, we've managed over $100 million worth of assets under management across the United States. We've transacted on more than 1,200 doors, and I've coached many investors through this exact process. Some of them had single family portfolios and they hit a wall. Some started with small multifamily, wanted to graduate into bigger ones. And some of them, like Ricardo, started completely fresh. Now, Ricardo's story is one that stayed with me, not because he was some kind of prodigy, but because he was willing to build the right foundation before he went looking for shortcuts. And that decision changed everything. Now, by the end of this video, you're going to understand why your track record is not the barrier you think it is, and exactly what to say to brokers when you don't have one. See, when I got started in this business, I didn't have a track record. I didn't know how to raise capital. I didn't know how to do anything in multifamily. And I thought, holy cow, how am I ever going to find success in this industry? We're going to talk about that. We're going to talk about how to actually research and select the right markets. We're going to select the right markets so that you're not following trends that institutional money already acted on 3 years ago. We're going to show you how to find the markets that are pre-explosion so that you can benefit and take advantage of that explosion. And we're going to talk about what to look for when you physically walk a property. Things that no spreadsheet, no course, no inspection report will ever catch. All right, so here's how this is structured. First, I'm going to tell you who Ricardo was when he came to me and what we were working against. Then I'm going to break down the 3 pillars I taught him. And then I'm going to walk you through the Winston-Salem property walk and what I saw in that parking lot even before we got out of the car, and what it means for how you approach every deal you ever get close to. All right, so who is Ricardo? The before picture. When Ricardo first reached out to me, he was a young guy, newly married. They just moved to Miami. He'd grown up in Colombia. He had like I said, he's running restaurants, family business, all of that, very entrepreneurial mindset. He had a lot of drive. And what I quickly learned is that he had zero background. Now, when I say zero experience, I mean it literally. He didn't know the lingo, the jargon. He didn't know how deals were structured. He'd never spoken to a commercial broker, never ran comps, never underwrote a property. He still thought that he needed his own money to buy real estate, and he didn't understand how to get to the next step. The only thing he knew is that he wanted to build wealth, and he'd heard that multifamily was the way to do it. Now, a lot of people who come to me are in the same version of that position. Some have owned single family homes for years, and they're hitting a ceiling. They want to graduate to that next level, multifamily. Some people are like Ricardo. They're starting from a clean slate. Either way, there's a gap. There's a gap between where you are and what this industry expects. And if you try to close that gap the wrong way, if you run at a deal before you've built the foundation, you're going to get trampled. You're going to get hurt either by missing a property issue that costs you time and money. You're going to get hurt by burning broker relationships before they start, or by buying in a market you don't actually understand. I see so many people thinking that they understand how to analyze markets and they always get it wrong. And Ricardo, he could have made any one of those mistakes, but he didn't, because we started with the right sequence. Now, here's what most new investors believe is holding them back. They think it's one thing, or a couple of things actually. They think it's access. They think if I could just get someone to send me a deal or get into the right room or find a mentor who'd let them in, everything would fall into place. See, access, not the problem. I've seen people get handed deals and walk away with nothing because they didn't know what to do with them. I've seen people get into rooms with experienced operators and come out exactly the same way they went in. See, the problem or the challenge is skills. Specifically, 3 foundational skills that almost nobody teaches properly, because most of the people teaching multifamily aren't actual operators or don't have the experience to teach anybody else. They learned from someone else's course and built a following, and what they teach reflects that. With Ricardo, we built real foundation, and I'm going to walk you through each piece of it, setting up the framework so that you can have success if you follow the framework. All right, there are 3 things I taught Ricardo, and these aren't Ricardo specific. They're the 3 things I teach every new student who walks through that door. So let's get into it. The first thing that we talk about is market research. How to find the right market. Because there are different markets in the United States. For example, Miami is completely different than North Carolina, which is completely different than New York, Chicago, Dallas, LA. These markets are completely different. And if you don't understand the nuances between each one, and you don't know how to run a deal in that specific market, you're going to fail. And understanding them deeply before you ever pick up a phone is crucial to your success. The second thing that we're going to talk about are broker relationships. Brokers, my mentor told me 1 broker will make you money, 2 will make you rich, 3 will retire your downline. The more brokers you have in a market sending you deals, the more deal flow you have, the more opportunities you have to become successful. However, the key is getting brokers to take you seriously and to send you the deal flow when you don't have a track record. See, this is the one where most new investors get completely wrong. And we're going to talk about that in a second and how to get past that. And the third thing that we're going to talk about is what I call field awareness or physical due diligence. This happens, or this is important, because you need to know what to look for when you're physically walking a property. Because when you walk a property, when you put eyes on a property physically, when you're there, you will see things that no document, no spreadsheet, no inspectors, nothing will show you and will teach you. Now, each one of these matters. Each one builds upon itself. And when Ricardo had all 3 working, he had something most new investors don't. A real foundation. A real foundation for doing deals. So now let's get into it. Let's talk about pillar number 1. Pillar number 1. Market research. Now, let me start with something that might be a little uncomfortable. See, most new investors pick their market the same way. They'll watch a YouTube video, they'll read an article, they'll see something on Instagram, and they'll see someone talking about Phoenix or Jacksonville or New York City, wherever the trend is that month. And they think, okay, that's where I need to be. See, that's not research. That's trend following. And by the time a market is popular on social media, the institutional money, the real players, have already been in and out of that market 3 times. See, real market research starts with fundamentals. Okay? Now, it's not just the fundamentals, but you have to understand where the market is on the market cycle. Are we in a buyer's market or in a seller's market? Where are we? Are we at the height of the market? And if I buy here, will I lose money or will I make money if I buy? You need to know where the market sits on that market cycle. And we'll talk about that deeper as we get into things. But there are 5 things I look at when evaluating any market. Number 1, that's job growth. That is the holy grail when I'm looking at market research. This is it, job growth. Now, there are 3 phases of job growth. There's the cut. There are phases of job growth. There's the pre-announcement, the announcement, and then the fulfillment. Pre-announcement is when you hear it on the news. Oh, Amazon just broke ground on a 5 million square foot facility. Fulfillment is when they start actually hiring people. You want to be in the pre-announcement or in the announcement phase of that job growth. You also want to understand that these aren't just jobs that I'm looking at. I want to understand, is it white collar, blue collar, green collar? What kind of collar are coming in there? Where in the market, where in the city are they moving to? How many jobs are coming in? Are they temporary jobs? Are they permanent jobs? See, are they diversified jobs? Meaning, are they in multiple different sectors or is it just one? Understanding job growth will help you determine where in that city to buy, if that city is the right city to buy in, and it leads into other aspects as well. With job growth, we want to look at what are the major employers. Are they in stable industries or cyclical ones? Is the employment base, like I said, is it diversifying or is it concentrated in one area? The second thing we want to look at is, which goes hand in hand with job growth, is population growth. How many families are moving in? Who's moving in? Are people coming in or moving out? Where are they coming from? Here's a great place to search, uhaul.com, one-way destinations. Why are they leaving those places and coming to this market? What is attracting them here? Do they have good local government? Does the local government understand that job growth is essential for a thriving city? Very important. Number 3, rent trends. What have rents done over the last 3 to 5 years? What's happening with supply right now? Is there overdevelopment of apartments in this area, which means that rents will be compressed for the next several years until that absorption goes up, until people move into those units? Then you can start pushing rents. What's happening over the next 24 months in that market when it comes to rent trends? What is vacancy looking like? Have the rents been flatlined? Have they gone up? Have they gone down? What's the delinquency in that neighborhood? These are the things that you want to look at when you're going into a market and researching that market. 4 is price to rent ratios. This is the number that tells you whether the math actually works. And I'll give you a little secret. When you're looking at a price per door, let's say the price is $200,000 per door. You're buying a 10-unit property, and it's, let's say, $50,000 a door. You want the rent per each door to be 1% of that $50,000. So that's $500. If it's $200,000 per door, meaning you're buying a 10-unit property and it's $2 million, $200,000 per door, your rent should be around $2,000. It's the 1% rule. You can Google it. You can ask Claude. Now, you can love a market from a macro perspective and still not be able to make the numbers pencil at any current pricing. Number 5 are forward indicators. What's being built? How many new units are coming online? How many permits have been pulled in City Hall? How many permits are actually now being constructed on? What does the city master plan look like? Where is infrastructure spending going? It tells you where the market is heading, not just where it is today. See, these 5 things, job growth, population growth, rent trends, price to rent ratio, and forward indicators, these 5 things together give you a real picture, not an opinion, not a trend. These are data-backed. This is a data-backed case for why a market is worth being in right now. Understand market research. See, when Ricardo came to me, the first thing he wanted was to invest in South Florida. He was living in Miami. It's what he knew. Latin Americans love Miami. It's the gateway to America. I told him no. At that time, even today, South Florida prices are not supporting the returns we're looking for. Cap rates are compressed, competition is intense, and it's not the market for a first-time operator building a foundation. So we ran the analysis on several different options. What came back strongest were 2 areas. Jacksonville, Florida, and the North Carolina corridor is specifically around Winston-Salem. Job growth was solid and diversifying. Population was moving in from higher coastal markets. Rent trends were positive without, being overheated. Supply wasn't overwhelming demand, and prices were still at a level where the numbers actually worked. But here's what mattered most. Ricardo just didn't take my word for it. He ran the analysis himself. He built the case for those markets through his own research. He could tell you why they made sense. Not because I said so, but because the data said so. Now, I want to pause here because there's something most people miss about this step. When you do this work properly, 2 things happen. First, you actually know whether you're in the right market or not. You're not guessing. You have your own analysis. But the second thing that it does, and this is the one that pays off immediately, you become credible. You become credible to brokers even before you've done a single deal. See, because when Ricardo called a broker in Winston-Salem and could speak intelligently about, local employment base, where in that market is the better area to invest in, demographic trends, the supply pipeline, he didn't sound like someone who just Googled the city the night before. He sounded like he belonged there. And that leads us into pillar number 2, which is, do you remember? That's broker relationships. This is a relationship business. And this is a wall that every new investor hits. All right, let me describe something to you that I've seen happen hundreds of times. A new investor decides they want to get into multifamily. They're motivated. They've done some research. Maybe they've taken a course and, or watched a YouTube video. They pick up the phone and call a commercial broker. The broker asks one question. How many deals have you done? What was the last deal you've closed? And the new investor says 0. The broker moves on. See, that question is the wall that most new investors crash into. And most of them never figure out how to get around it. Not because they're not capable, because nobody has ever shown them what to say instead. And this is exactly where Ricardo was. No deals, no track record, no prior relationships with commercial brokers. And the deals he wanted, the 30, 40, 50, 100 unit deals, those are the properties that can move the needle for him. And they were sitting behind those broker networks. So how do you get in? It's a great question. The positioning is the strategy. And here's what I taught Ricardo. But not only Ricardo, here's what I teach every student who comes to me in this position. See, when you're new, and it was the same for me, you can't sell experience you don't have. I didn't have experience in multifamily when I started. That's just a fact. But you can position yourself through the experience and resources of the people around you. Now, no one told me this when I was getting started in multifamily. I wish they would have done that. See, this is not about being deceptive. It's about leading with what's true and relevant. See, Ricardo was working with me at the time. I had 15 years in business, millions of dollars in assets under management, and a team of widely experienced operators. That's real. And a broker should know about that. So instead of leading with, "Hi, I'm Ricardo. I'm new and looking to buy my first apartment complex," this is the framework that Ricardo used. "Hi, my name is Ricardo. I'm working with Nizan and his team, and they've been in multifamily for over 15 years. We're looking to acquire 500 to 1,000 doors in your market over the next 12 months. I'm the boots on the ground. My job is to find the right properties and get them in front of the right people. Now, if the numbers make sense, I bring it upstairs." That's the script. Simple, easy, taking the spotlight off of him and putting it on his team members who have the experience. He's not lying. He's working with an experienced group. He is the boots on the ground. And if a deal works, it does go to people with more experience and more capital. See, but the frame is completely different from, "I'm new and I'm trying to figure it out." Now, brokers started returning his calls after he changed his framework. You see, commercial brokers are relationship driven. Let me write that down. They are relationship driven. They work with people they believe that can close. And when you're new, trust comes from association. If you're credibly associated with experience and capital, you get treated differently from a solo operator with nothing to show. And I'm proof of that. When I started in this business, I tacked on to someone who was more experienced and their team, and I used their experience and their knowledge to build that gap between myself and the brokers. See, that positioning gets you in the door. It doesn't keep you there, but it gets you in. What keeps you there is knowing what you're talking about when the conversation goes deeper. See, that's why pillar number 1, market research, matters so much. Because when Ricardo was on the phone with a broker and the broker started asking about the market, guess what? Ricardo could answer those questions. He'd done the research. He knew the submarket dynamics. He wasn't bluffing. The positioning opened the door. The market knowledge kept it open. Now, Ricardo started making broker calls consistently, not once or twice, but every week, multiple times a week. He was building relationships. He was receiving packages, property packages. He was underwriting properties. He walked away from some deals and he went deeper on others. He kept his focus on the fundamentals. Then one day, the right property came across his desk. Winston-Salem, North Carolina. He ran the numbers. They worked. He submitted an LOI, and the LOI was accepted. He called me, excited. I got one. And I got on a plane and met him there. Now that leads into pillar number 3. You remember what that was? Field Due Diligence. Field due diligence, this is what a document cannot tell you, what a spreadsheet can't tell you, what photos can't tell you. Now, I want to be clear about something. Before I walk you through what happened in Winston-Salem, you can do all the paperwork correctly. You can have all the financials reviewed, the rent roll analyzed, the T12 scrutinized. You can have a professional inspection done. And yes, all of that matters. I'm not dismissing any of it. But there is a level of pattern recognition that comes only from standing in front of hundreds of buildings. And that recognition does not come from a checklist, a course, or an inspector's report. It comes from experience. And in the absence of your own experience, it comes from having experience of people who are physically on the ground with you working that deal. Now, this is something I tell every student I work with. When you're close to a deal, when you're heading toward an LOI, get on the ground. And if you can bring someone with you, someone who's already made the expensive mistakes so you don't have to, it's an added win. So let's talk about the property. We pull into the parking lot. The property was a mid-sized apartment complex, over 100 units in Winston-Salem, exactly the type of asset Ricardo had been focused on and what we've been working towards. And before we even stepped out of the car, I was already looking. And what I noticed was that the siding of one of the buildings was bubbling and it was sticking out. It looked like the building was pregnant. The siding was buckling. It was pushing outward from the structure. And it's funny because the inspectors and everybody that was on site walked right past it. Ricardo walked past it. No one paid attention. I saw it. I saw it and I made note of it. And the reason why I was able to see it and Ricardo wasn't able to see it is because I've seen it before. And because I've seen it before, it registers immediately. And I called Ricardo over and I pointed at it. I said, Ricardo, what do you see? You see that siding? He looked at it. Yeah, what about it? I said, doesn't it look pregnant? It's sticking out. He's like, what is that? I go, well, it could be water behind it. Could be water damage. Could be water sitting in the wall. I don't know what it could be. Either way, that's not a small repair. Now, he hadn't noticed it. He was looking at the entrance, the parking, the condition of the landscaping. Now, all normal things to check. But the siding was telling us something before we even opened the door. Something that nobody had looked at. But if you have experience, and you're with someone who has experience, they know what to look for so that you can protect yourself and your investors. Then the second thing, I looked at how the property was sitting, the topography on the land. See, it was built on a hill. There were units on top of the hill, there were units in the middle of the hill, and then there were units at the bottom of the hill. And there was a floor unit that was sitting at the very bottom of that slope. And I said to Ricardo, I'll bet you anything that unit right there, that has flooding and mold issues in that unit. And when we walked the property and we got to that unit, guess what? I was right. Before we walked through the entire property looking at, I want to talk about what this means for how you approach field due diligence. Because I don't want this just to be a Ricardo story. I want it to be something you can use. See, when you walk a property, you're looking for things that cost money that are not priced into the deal. You're looking for deferred maintenance. You're looking for structural issues. You're looking for things that could pop up when you take ownership. Now, the categories that matter most fall under two main headings. One is structural. When you're walking the exterior, you want to look for cracks. You want to look for eroding land. You want to look for any structural issues on the property. Then the next thing you want to look for are water-related issues, because sometimes these two things cannot be fixed. If your property sits at the bottom of the hill and it's in a rainy part of town or in a rainy market or whatnot, it's always going to get flooded. You can't change that. If the land has eroded and the property is tilting or the foundation is cracked, it's going to cost you a lot of money. Those are the two things that can turn a good investment into a money pit very fast. All right? So when you're looking at siding, it's buckled or warped. What does it mean? What is it talking about? On the exterior, other than the structural issues, you're looking for anything that suggests water intrusion, right? Like the buckling or warped siding, which is what I saw in Winston-Salem. You want to look at rust stains running down the roof lines or window frames, or that efflorescence on a brick or block, right? That white chalky residue, which means moisture is moving through the masonry. Okay? Topography, right? We talked about that. Where's the property sitting relative to the surrounding land? All of that. Is there any standing water or staining near the foundation? These are things on the exterior you want to look at. Now on the interior, you're looking at the ceilings and baseboards first. Stains, discoloration, soft spots, any cracking, any movement. You're looking at HVAC systems. How old are the HVAC systems? When were they manufactured? How many units on one system? When was it last serviced? You're also looking for plumbing and electrical panels. You're looking at the hot water heaters. When were they manufactured and installed? And none of this requires a contractor's license. I'm actually going now and doing due diligence in the first 2 days that we're going to be out there. Myself and my team are going to walk specific units before we even bring an inspector on. We're going to look to make sure that the HVACs, that the hot water heaters, that the electrical panels were all updated in the last 10 years. You don't need a contractor's license. It requires you to pay attention to the right things. And if you're on a property and you're not sure what you're looking at, don't walk away from it. Call someone who knows. That call costs nothing, but missing what it's telling you might cost you everything. All right. Let me bring the 3 pillars down to something practical, because the whole point of a video like this is to walk away with something you can use. So if you're starting out in multifamily, if you're in the position Ricardo was, or something close to it, here's the sequence that actually works. You want to start with market research before you call a single broker. before you look at a single deal. You pick 2 or 3 markets, you run them through the 5 fundamentals, the market cycles, are they in a buyer's market, seller's market, and you build a genuine understanding of why those markets make sense right now. Right? This takes a week, 2 weeks, takes time, and it's not optional. Then you go and you build broker relationships. Because now you know what city you want to be in, what part of that city, where are people migrating to, what part of the city is the city master plan working with, where are they gentrifying that area. You know that. Now you go and you start calling brokers in those areas. You get your positioning right before you pick up the phone. Remember, you don't need a track record. You need a clear, honest frame that leads with the people and resources behind you. And I want you to adapt Ricardo's script to your situation and use it. Then I want you to start calling consistently, weekly, not once and then wait for a response. Every day, multiple times a day, different brokers. Then during this phase, you start getting deal flow. You start underwrite, and once the deal flow comes, I want you to underwrite every single deal because you need to start working. It's like it's a muscle memory. You need to start using that muscle, that underwriting muscle, that analyzation muscle, so that you can start seeing patterns. I look at a T12 today, I automatically pick up anomalies. I look at a property even on pictures today. My eyes automatically look at certain things that other people don't see because my eyes are trained for it. And that's what I want for you. I want you to get trained so that you can start picking up these anomalies quickly. So underwrite everything. Don't wait for a perfect deal to start. Underwrite the imperfect ones, the crazy ones, the ones that you never would think to buy, because that's where pattern recognition develops. And that's how you eventually know what a good deal looks like, by having seen what a mediocre or crappy deal looks like. And when you get an LOI accepted, I want you to get on the ground. I want you to walk the property. You see, field due diligence is not only looking at the property physically with your eyes and walking all of the units. It's going around to all of your comps, driving the neighborhoods, going to other properties that are like your properties and walking those properties, talking to the property management over there, asking them questions. What's it like? Do you have a waiting list? Are you offering any concessions? Can I see some of your units? Are you offering renovated units? What do they look like? How much are you investing in your units to renovate, and what's your upside? How much money above regular rents are you getting? That is field due diligence. Knowing the market, knowing your asset, walking the property with your own eyes. Because when you can talk to an investor, when you can talk to someone and say, I was there, I saw it with my own 2 eyes, I drove other properties, I drove down the block, I drove the area, I know exactly what's going on there. That is you giving your investors confidence in you, that you know what the hell you're talking about, right? So when you get an LOI accepted, get on the ground, walk the property. And if you can, bring someone with you who's walked hundreds of buildings. Don't just rely on an inspector, right? I want you to have someone who can look at a building from the parking lot and tell you what they're seeing. This sequence, research first, then relationships, then deal flow. It's the same sequence Ricardo went through. And it works because each layer makes the next one stronger. But let me tell you what happens when you skip steps. See? Because here's what I see happen when people try to shortcut this. They skip the market research and they jump straight into deal hunting. So when a broker asks why they like a particular market, they don't have a real answer. When a broker sends them a deal in that city, but it's not in the right neighborhood, and they don't know about it, they start underwriting it, spending hours and hours and hours analyzing it, running market comps, research, all of that, just to later understand that's not the neighborhood you want to be in. brokers will stop sending you packages. Or people try to wing the broker positioning. I'm just getting started, but I've been to a boot camp and I know what I'm doing, right? They say they're new, they're looking to learn, they want a mentor, all of that stuff. And brokers, some brokers are polite, some are just like, dude, they'll just hang up the phone on you. But I can tell you this, they're not going to send you their off-market deals. They're going to send their inventory to someone who sounds like they can figure it out, that they've figured it out. Someone who's on the broker's list that they know can close, right? Or they go under contract without real field due diligence. You've never seen the property. You rely on somebody else. You rely on the documents, on the inspection report, and then 3 months into ownership, that buckling siding issue that you thought wasn't there because you didn't check, you didn't know, can now turn into be a $60,000, $100,000, $200,000 remediation job. I know, I've seen it. It's happened to me. That's how I know. None of these things have to happen. They happen because people run at the result without building the foundation first. And Ricardo, he didn't do that. Not because he was exceptional, because he was willing to do the work in the right order. All right. Let me give you the full picture of where Ricardo ended up. He came to me with no real estate experience, no broker relationships, and no market knowledge. Through the work that we did together, he built deep knowledge of 2 markets, Jacksonville and Winston-Salem. He built consistent broker relationships in both. Deal flow started coming in. He was underwriting properties. He was submitting LOIs, doing exactly what I told him to do, step by step by step. And then he got one accepted. It was a multifamily property in Winston-Salem, North Carolina. And at that point, he had the market knowledge to know why that market made sense. He had the broker relationships to get the deal across his desk in the first place. And he had enough field awareness to know he needed experienced eyes on the property before he made any moves. Now, is Ricardo a finished product? No, nobody in this business is. Every deal teaches you something. But the foundation he built gave him a legitimate platform to operate from. And he no longer needs to borrow my credibility in broker conversations because he's built his own. After 2 years, he's acquired 1,700 doors. He's built a massive team around him, and he and his team have raised over $30 million. He doesn't need my track record anymore. Ricardo and I today are partnering on deals. We're doing bigger and better deals. Now, I want to talk to you about the traditional way of doing things versus the traditional approach versus the right approach. All right. Let me show you the contrast because I think it matters. See, most people who want to get into multifamily are taught one sequence, the traditional sequence. What's the traditional sequence? Very simple. Find a deal, right? Easy enough. Raise the capital, okay, and then close. Close on that deal. That's the traditional way. Now, technically, that's not wrong. That's the sequence. However, it skips 3 layers of preparation that determine whether the deal you find is actually worth closing, whether brokers take you seriously enough to send you real opportunities, and whether you understand what you're buying when you stand in front of the building. See, what Ricardo did was different. He built market research, market knowledge, right? He built that market knowledge before he went to the brokers. Then from there, he built broker relationships. And then once he built those broker relationships, he went looking for deals. And once he did that, he developed field awareness or due diligence. And he developed this before he ever put his name on an LOI. Each layer made the next one stronger. And by the time we were standing in that parking lot in Winston-Salem, before we even opened that car door, Ricardo was paying attention in a way he couldn't have 18 months earlier. But he still didn't catch the pregnant sighting right away. And that's okay. That's what I was there for. But he was looking. He was asking the right questions. He was doing the work. And that's what a real foundation looks like. All right, so let me bring this together. The 3 things I taught Ricardo, and the 3 things that got him from working or owning a restaurant in Colombia to a property walk in North Carolina were: Pillar 1, market research, real fundamentals-based analysis, understanding where if a market is emerging or if it's on the downturn, right? 5 categories done before you pick up a phone or look at a single deal. Your market research has to come first. Then pillar number 2, broker positioning, a clear, honest framework that leads with the experience and resources around you, not the track record you don't have yet. And I just want to make this clear. Think about it like this. You've got the Super Bowl or the NBA champion team. Let's say the Michael Jordan basketball team for the Bulls that won 6 championships. And you're coming onto that team in their 3rd year of winning championships. And the Bulls go to the championship, NBA finals, and they win again. You being the newbie, you've never played a minute on the court. Do you still get a ring? Absolutely, because you were on the team. Jordan's success was that newbie's success. So your team's success in multifamily flows onto you. So surround yourself with successful people that you can say, we are working together. These people are on my team. I'm on their team, whatever the lingo is, right? So don't worry if the track record, or don't worry if you don't have a track record. Use somebody else's track record. Success by proximity. And then when you call the brokers, I want there to be consistent outreach. It's relationship building over time. And then pillar 3 is the field due diligence. Get on the ground, read the building, drive the market, look at other properties in the area, talk to other property managers managing other assets. Knowing what to look for or bringing someone with you who does is essential to your success in this business. So now here's one thing I want you to take away from Ricardo's story. The thing you think is holding you back probably isn't. See, most new investors believe they're stuck because of their track record, their access, not knowing the right people, not having money, all of that, all those myths. Ricardo had none of those things when we started. But what he had was the willingness to build the foundation properly before going looking for shortcuts. And when you build the right foundation, the track record comes, the relationships come, the deals come, but you can't shortcut the foundation. And again, think about it this way. We're in real estate, right? When you want to build a tall building, what's the first thing you have to do? You have to go down. You have to dig deep down into the ground and build the foundation first before you could ever think of going up. The stronger, the deeper the foundation, the taller, the bigger, the more massive the building and the construction. And the same thing goes here. The stronger your foundation is, the bigger your empire can be. So if Ricardo's story sounds like where you are right now, if you're trying to figure out the right way to build a real foundation in multifamily, I want to help. Inside the Multifamily Accelerator, this is exactly what we work on. The market research, the broker positioning, the underwriting, the field work, the real skills that get you to your first deal. The link is in the description below. Come in, have a look around. And if this video gave you something useful, share it with someone who's trying to figure this out. Sometimes all it takes is seeing that someone else started where you are and made it work. I'll see you in the next one.